All right. Good evening, everybody. Seems like we have most of our attendees joined so far. So thank you very much for taking the time to be with us this evening. My name is Michael Lafata, and I am one of the advisors here at Archstone Financial. On behalf of my colleagues at Archstone and Gatehouse Financial, thank you for taking the time to join us this evening. This is our annual Social Security webinar that we conduct. And I think it's a great time to have this webinar. We have an extremely qualified guest with us this evening. He's been here before, and he just does such a great job that we love to have this event with him every year. So Kurt Czarnowski is the former Regional Communications Director for New England of the Social Security Administration, and he's the current principal of Czarnowski Consulting. He has constructed a presentation titled Social Security Fairness Act of 2023. And within this presentation that he's about to show, he's going to provide a wealth of information about the Social Security system. He's going to cover topics about when somebody can start to collect, how retirement benefits calculated, a whole bunch of stuff that he's going to go over. He's also going to touch on the recent developments that have taken place within Social Security Administration. A couple really important things have taken place recently, so that's he's certainly going to spend some time there. And before I hand it over to Kurt, I would like to mention that if you do have questions, please feel free to use the raise hand function at the bottom of your Zoom screen. You can shoot us an email. Please, you can send your advisor an email and they can forward that over to us. Or use the chat feature at the bottom as well of the screen. We'll have plenty of time at the end for questions. And if there's something on your mind, please don't hesitate to ask. With that being said, Kurt, the floor is yours.
Thank you, Michael. Good evening, everyone. As Michael said, my name is Kurt Czarnowski, currently the principal in Czarnowski Consulting. Those one or two of the webinar haven't been with me before. Proud to say we're an international consulting firm whose world headquarters, conveniently located right here in a spare bedroom of my house in Norfolk, Massachusetts, which is where I'm coming to you from tonight. But don't worry, at Czarnowski Consulting, we like to say we provide expert answers to your Social Security questions. And why can I say that? Well, simple. I worked for Social Security for 34 years. And for the last 20 years of my career, my job was as the communications director here in New England. And in my retirement, such as it is, I'm now in my 15th year of spending time, as our Canadian friends would say, well, if they're still our friends, boot and a boot, talking to people about the Social Security program. So it's a pleasure to be back with you tonight, talking about the Social Security Fairness Act of 2023, which is probably the most significant piece of Social Security legislation passed in the past 10 years. Now, for those of you who know me, and even those who don't, I'm a fairly cautious guy. And throughout my life, I've been very reluctant to make predictions, especially about the future. Oh, come on, that's an old Yogi Berra line. It's hilarious. But I date that back to October of 1986, when with 2 outs in the bottom of the 9th inning, nobody on base, I turned to my wife and said, oh my God, the Red Sox are going to break the curse of the Bambino and they're going to win the World Series. Well, it didn't turn out that way. So I've stopped largely making predictions, but with one exception. In my 34 years with the agency, my 15 years out, talking to people about the program, I don't know how many times I've been approached by public employees all over the country that I talk to who say, hey, what about this windfall elimination provision? What about this government pension offset? Do you think they're ever going to get repealed? And my stock answer was no, they're never going to get repealed for 2 reasons. Number one, they impact a relatively small percentage of the Social Security beneficiaries in this country, somewhere around 3 or 4%. But the other reason I would hang my hat on was, looking down the road, Social Security's big issue is that, according to the latest trustees report, beginning in the year 2035, the system is not projected to have enough money to cover 100% of promised benefits. Beginning in 2035, again, assuming no changes to the program whatsoever, the trustees predict Social Security will have only about the revenue sufficient to cover about 83% of the benefits. And it always seemed to me that to change the windfall elimination provision and the government pension offset, the way people wanted it to be changed, it would certainly cost the system money. And so for those two reasons, I always said, nope, never going to happen. It's never going to be amended, never going to change. So live with it. Well, lo and behold, what happened? Well, on January 5th of 2025, then President Biden signed into law the Social Security Fairness Act of 2023. Now, it's called the Fairness Act of 2023 because the legislation was initially introduced in 2023, even though it didn't get passed until 2025. And that legislation basically repealed both the Windfall Elimination Provision and government pension offset provision of the Social Security program. But wait, there's more. The legislation eliminated WEP and GPO for all Social Security benefit payments made after December of 2023. And so this is a huge change, and it's important for people to understand what the Social Security Fairness Act is all about, who it impacts, how it's being implemented, and what the future of the program means. So the big thing to remember, first and foremost, is the Windfall Elimination Provision and government pension offset provision are two provisions of the Social Security program which impact public employees, and here's the key part, who receive a public pension which is based on work not covered under the Social Security program. So the Social Security Fairness Act doesn't impact all public employees necessarily. So, for example, teachers in New York State do pay into the Social Security program as part of their teaching work. And so because they were paying into the Social Security program, they weren't impacted by either the windfall provision or government pension offset. So it's public employees who receive a public pension based on work not covered under Social Security. Now, obviously, here in Massachusetts, this has been a big deal because no public employees in Massachusetts pay into the Social Security program. Teachers, for example, pay into the Mass Teachers Retirement System. State and local employees pay into the state retirement system, or a few of those county retirement systems that are still in existence. So these folks have been impacted by the windfall provision and government pension offset. The other thing to remember, though, is WEP and GPO only impacted public employees who received a public pension that was based on their own work activity. So if you were a survivor of a Massachusetts police officer who had died, left behind a survivor annuity, that survivor annuity never triggered the windfall provision and or government pension offset, because while it was a pension based on work not covered under Social Security, the person who received the pension wasn't subject to WEP and GPO because the pension wasn't based on that person's work activity. So again, we're talking about windfall elimination provision, government pension offset, two provisions of the Social Security Act that were eliminated, effective with payments made after December of 2023, meaning payments beginning effective with the month of January 2024. So let's talk about the WEP first and then GPO. The windfall provision, that applied to someone who received a public pension based on work not covered under Social Security, but who, in addition to that, had worked and had paid into the Social Security program and had accrued at least 40 Social Security credits. Now, back in the day, you got Social Security coverage by earning what were called quarters of coverage. That term went out of business back in 1978. Now you get coverage and protection by earning Social Security credits. And with the Social Security retirement program, to qualify for any type of Social Security retirement benefit, you needed to accrue at least 40 Social Security credits. Now, you can earn a maximum of 4 credits in the course of a year, but once you had accrued 40, you were, in the terms of the legislation, insured for Social Security benefit, which meant you were absolutely positively entitled to collect something. But the windfall provision applied to those people who had gotten their 40 credits, but who, in addition to that, had received or were receiving a public pension based on work not covered under Social Security. Now, the good news for those folks impacted by the WEP was with the windfall provision, as long as you had your 40 credits, you were absolutely, positively going to receive something each and every month, even though you received that public pension. That was the good news. You could never be reduced to zero. But the bad news was if you had that public pension, then with fewer than 30 years of time working and paying into the Social Security program, then the amount you received each month from Social Security was going to be less than it would be if you didn't have that public pension. Because the windfall provision basically required Social Security to use a different and admittedly less generous formula to calculate the amount of the person's Social Security payment. But again, they always got something, but with fewer than 30 years of time under the system, they didn't get as much as they would have if they didn't get that public pension. And what was the rationale for the windfall elimination provision? Well, the WEP was part of legislation passed back in 1983. And that was actually part of a significant package of legislation that was designed to help address long-range solvency of the Social Security program. But as part of that package of legislation, Congress saw that Social Security's benefit calculation formula was, in essence, a progressive one. And that's not surprising. Social Security, as the name implies, is a social insurance program. And in creating the program, Congress always intended to build certain social goals into it. And one of those was always designed to help people who were in lower paying jobs by providing them with a monthly benefit amount, which is intended to replace a higher percentage of that person's pre-retirement earnings. Why? Well, because Congress recognized that people in lower paying jobs were less likely to have a pension of any type, less likely to be able to save for retirement during their working years because they need the money for food, clothing, and shelter. So the basic Social Security calculation, again, a weighted or progressive one designed to help people in lower paying jobs. And it was designed to replace around 55% of what somebody was making at retirement. Now, for a higher earner, by all means, he or she would receive more each month in absolute terms than that low earner does, but the program designed to replace a smaller percentage of that person's pre-retirement income, around 34%. And for the average worker, the Social Security payment always been intended to replace only around 41% of what the person's making in retirement. It's a base, it's a foundation. It was never intended to be anyone's sole source of income in retirement. But even though it's a base or a foundation, it was designed to help, as I said, people in lower paying jobs because there was a recognition they were probably less able to come up with those additional dollars to supplement their Social Security benefit. So back in 1983, Congress saw that public employees who were not covered in the Social Security program as part of their retirement planning package would come to Social Security. Social Security would call up the person's work history. And because all that Social Security would have is their work activity under the Social Security program, in other words, they wouldn't have the earnings that a Massachusetts school teacher might have had paying into the Mass Teachers Retirement System. At first blush, then, it would appear that this individual would be one of these historically lower earners because their earnings history would be checkered, be intermittent, wouldn't be very high. And prior to the enactment of the WEP, they would receive the benefit of that progressive benefit formula. What Congress recognized back in 1983 was that Social Security was really operating on incomplete information. And that if Social Security had at its disposal a record of person's earnings under the Social Security program, as well as the person's earnings outside of Social Security, then they probably shouldn't have been considered one of these historically low earners. And so the creation of the windfall provision and the different benefit calculation formula was designed to smooth out basically some of that weighting that was in the standard Social Security retirement benefit calculation, and smooth out some of that weighting. So those people whose primary work activity was outside of Social Security would not be viewed as historically low earners, but probably more like average earners. So here's an example of the Social Security basic benefit calculation that was in effect last year, a hypothetical. So the law said Social Security, the first step, they go and they do adjust somebody's earnings for inflation and then average them over somebody's 35 highest years of work under the system. That's a huge area of misunderstanding and myth. A lot of people mistakenly think, oh, it's my high 3 or my last 5. No, it's based on an average of a lifetime of earnings, which is an average of somebody's 35 highest years of work. So they average the person 35 highest years of work, divide by 12, come up with a dollar figure that represents the person's average monthly wage under the system. And in 2024, system said, or the calculation formula said, okay, you get somebody with average earnings of $8,000 a month over their high 35 years. To calculate their benefit, the law says they take 90% of the first $1,174 of that $8,000. They take 32% of any earnings up through $7,078, and they take any 15% of any earnings above that, add those three things up, and that provides the Social Security benefit amount for the individual. So as you can see, it's a segmented calculation, but it is weighted towards people in the lower end of the scale, provides a higher rate of return for that lower amount of earnings that somebody might have. What Social Security is required to do then with the windfall provision in calculating somebody's benefit who has been receiving one of those public pensions is, again, to use a different formula. Now, the first two steps are the same. They adjust prior year earnings for inflation. They then average the earnings over the high 35 years of work that the person has had, come up with that same dollar figure that represents their average monthly wage over 35 years. But in the formula, instead of calculating and giving 90% of the first $1,174, Social Security gives the person only 40% of the first last year, $1,174. The remaining two steps in the calculation are the same. So that's where the difference in the formula comes in. But Congress also recognized that there may well be cases where somebody has, or Social Security's earnings history is a far more accurate representation of their true work record. And so the law has always allowed for someone who has had more time under the Social Security program to receive a monthly Social Security retirement benefit, which is closer and closer to a normal, regular, average calculation. And it works out that anyone who has had 20 or fewer years under the Social Security program, sure, that first segment of the formula is 40%, but working your way up, the more time somebody has had, up towards 30 or more years of time, then the closer and closer they get to a normal Social Security retirement benefit. But again, that's the idea behind the windfall provision. Somebody always gets something with the windfall. The amount of the pension has largely been immaterial. What has determined how much of an impact, how much of a reduction the person has incurred, has been based on the number of years of earnings that somebody has had under Social Security. Again, you need 10 years of time to get your foot in the door and tie you to something. But then in terms of calculating somebody's benefit, it's based on an average of someone's highest 35 years of work under the system. But if somebody gets one of those public pensions, again, based on work not covered under Social Security, then the formula is different. And for somebody with fewer than 30 years of time, they get less each month than they'd receive if they didn't have that public pension. But the key thing with the windfall provision was you never were reduced to zero. You always got something but absent 30 years of time under Social Security, you got less than you would have received if you didn't have that public pension. So that was a windfall. Again, impacted somebody who gets that public pension based on work not covered under Social Security, but is looking to collect a Social Security retirement benefit based on their own work record. And as I keep harping on, with the windfall provision, you always got something, but absent 30 years of time, you got less than you would have received otherwise. Well, what about GPO, government pension offset? Well, the government pension offset provision actually has been around even longer than the windfall provision. Government pension offset was created back in 1977. And the government pension offset provision applies to someone who gets, again, that public pension based on work not covered under Social Security, but now is looking to collect a Social Security benefit, not necessarily based on their own work record, but based on the work earnings of their spouse, ex-spouse, or deceased spouse. And with government pension offset, frankly, the news is not as good. With a windfall provision, you are always going to get something. And the amount of the pension was largely immaterial. But with government pension offset, the amount of somebody's non-covered pension is particularly material, and it is possible for somebody, because of the receipt of that public pension, not to receive any type of spousal, divorce spousal, or survivor benefit. Because what the government pension offset rules required Social Security to do was to look at the amount of the spousal, divorce spousal, or survivor benefit that somebody might be eligible to receive, then look at the amount of the person's public pension, and they were then required to reduce that spousal, divorce spousal, or survivor benefit by 2/3 of the amount of the pension. So if 2/3 of somebody's public pension was more than the money they might receive based on their spouse, ex-spouse, or deceased spouse's work record, they didn't get anything more. Now, why does government pension offset exist? Well, one of the fundamental principles of Social Security in the spousal, divorce spousal, and survivor benefit rules is that you collect on one amount or the other. You don't collect both your own retirement benefit and a full spousal, divorce spousal, or survivor benefit. So, for example, with spousal benefits, and the spousal program created to support the model of the American family of the 1950s, the Cleaver family of the Leave It to Beaver TV show. Now, Michael has no idea who Leave It to Beaver is, has no idea who the Cleavers are. But Michael, in the Cleaver family, Ward Cleaver was the breadwinner. He worked. June Cleaver, typical stay-at-home housewife of the 50s and 60s. She didn't work a day outside the home in her life. Social Security rules say that Ward Cleaver is eligible for a benefit based on his own work record, whatever it happens to be. So let's say he gets $1,000 a month. June Cleaver, as his spouse, is eligible to receive a monthly spousal benefit equal to 50% of Ward's full retirement age amount, or in our example, $500 a month, that's payable to her even if she hadn't worked a day outside the home in her life. But as the 50s and 60s morphed into the 60s and 70s, in all likelihood, the June Cleavers of the world would have worked outside the home, would have paid into the Social Security program, and would have earned a benefit on their own. And so what the law says is, June Cleaver, you can receive a spousal benefit equal to 50% of Ward's full retirement age amount, or your own one amount or the other, whichever one is higher. So June, she's earned a Social Security benefit on her own of $750. Ward's got $1,000. 50% of Ward's is $500. If June's $750 benefit, as it is, exceeds 50% of Ward's, that's what she collects. It's one or the other. Whichever one is higher, you don't get both at once. So prior to the enactment of the government pension offset rules back in 1977, Congress saw that people in public sector jobs receiving pensions not covered under Social Security were being treated better than people whose work activity was under Social Security and had generated a Social Security benefit. Because back in the day, a public employee, say a Massachusetts school teacher, Say June Cleaver, mass school teacher, has a teacher's pension of $750 a month. Would go into Social Security, Ward would get his 1,000, and Social Security would say, June, you get any Social Security benefit? She goes, no, I never worked under Social Security. They would give her a $500 spousal benefit, which she would then receive in addition to the $750 teacher's pension that she was receiving. But if June had worked under the Social Security program, she would have collected either her own Social Security benefit or the spousal benefit, not both. So Congress saw that, as I said, public employees in these situations being treated better, excuse me, than people who were covered under Social Security. So the government pension offset law said, okay, before we'll pay that spousal, divorce spousal, or survivor benefit payment, we are going to look at the amount of the person's public pension, figure out what 2/3 of the pension is, and reduce any type of spousal, divorce spousal, or survivor benefit by that 2/3 of the pension, bringing those public employees then under that umbrella, that same concept. You collect on one account or the other at a time. You don't get a full Social Security benefit and a full spousal benefit at the same time, one or the other. So again, with government pension offset, the amount of the pension was material because 2/3 of the pension was used to reduce or offset any type of spousal, survivor, or divorce spousal benefit. And it was possible if 2/3 of somebody's pension, public pension, was more than what they could receive based on their spouses, ex-spouses, or deceased spouses' work record, it was conceivable that they couldn't get anything more from the Social Security system. Now, they'd always get their public pension, but with government pension offset, 2/3 of their public pension reduced whatever they might have been able to receive based on their spouse's work record. So that's a general overview of both the windfall provision and the government pension offset. As I mentioned, the Social Security Fairness Act eliminated both the windfall provision and government pension offset, effective with Social Security payments beginning January of 2024 forward. And so what Social Security has been telling people is, if you were in a situation where you had been subject to the windfall provision or had applied for spousal benefits and had your payment reduced because of government pension offset, then you didn't need to do anything. That Social Security knew who these people were, and they would begin taking steps to pay the retroactive money that people were going to be due, again, going back to January of 2024. And Social Security announced at the end of February that they were about to start paying retroactive payments beginning March 1st. And so far, Social Security has estimated there's around 3 million people that will be affected, will be receiving increases in their benefit payments. And they've estimated right now they've paid about 3/4 of the retroactive money that's due. Here in Massachusetts, about 109,000 people have already received their retroactive payments because of the elimination of the windfall provision and government pension offset going back. Now, it's important to understand what the law said is for you to be paid all the way back to January of 2024, you needed to be on the benefit rolls at that point, subject to the windfall provision, subject to government pension offset. But if somebody hadn't applied, hadn't been on the rules back then, it was possible for people to receive some type of retroactive payment, but it depended on whether or not the person was at what Social Security calls your full retirement age or older. For example, for anyone born 1960 or later, Social Security full retirement age is the month you turn age 67. And it varies based on somebody's year of birth. But if somebody applies for benefits prior to reaching full retirement age, then they can't be paid any earlier than the month they actually apply. So you've got a situation where you're a Massachusetts school teacher who's 64 years old, for example, you had never applied for Social Security spousal benefit because you knew that 2/3 of your pension was more than you could ever collect based on your spouse's work record. Well, Social Security says, yes, you should apply right now. You will need to apply. But because that person is not yet at full retirement age, they can't be paid any earlier than the month they actually apply. All right. So under full retirement, everybody should apply, but under full retirement age, excuse me, he can't be paid any earlier than the month you apply. But for people who are over full retirement age, the law says that you can request benefit payments a maximum of 6 months in the past. So somebody who's age 68 right now, for example, Massachusetts school teacher, never applied, applying now, government pension offset eliminated effective January 2024. You can't be paid all the way back to January of 2024 because you weren't on the rolls then, but you can request and receive up to 6 months of retroactive benefits. So important thing is for people who are on the rolls, sit tight. You don't need to do anything. Social Security has been making retroactive benefit payments through the course of this month, and they expect that all retroactive payments will be parceled out, maybe with a few exceptions, by the end of March. And then beginning in the month of April, people who have had their the windfall provision of government pension offset removed will see their new higher benefit amount effective payments made in April going forward. So again, with Social Security, they put on their website a page that the URL is shown on the chart. You can track progress in paying the benefits. They show the number of retroactive payments that have been made already. As I said, here in Massachusetts, it's a little over 109,000 people have already been paid. But then the question is, well, what going forward? So the important news is, so if you're one of these folks, a Massachusetts school teacher or a librarian or things like that, where you've been anticipating that you're going to be receiving a lower Social Security benefit because your eventual receipt of a public pension, the good news is weapon GPO will no longer apply. And for those folks who use or should have used a Social Security statement as the planning tool it was designed to be, would remember, if you're in that situation, on the Social Security statement, there was always a little dicta in there that says, hey, the benefit estimates may not be correct if you get a public pension. Well, the good news is there's no longer any WEP or GPO offset. And so you can rely on the information now shown on that Social Security statement as an estimate of what you can collect from the Social Security Administration going forward. And the key message from me is to use that Social Security statement, rely on the information, plan for retirement, but recognize that with the Social Security Fairness Act of 2023, the WEP and GPO impact has been removed, and you're going to be able to receive a full normal Social Security retirement benefit or spousal benefit or divorce spousal benefit or survivor benefit, even if you happen to receive that public pension. So that's a quick overview. Be happy to take questions from anybody who may have them.
Yeah, awesome. Thank you, Kurt. That was fantastic. We did have a couple questions come in.
Sure.
Let me try and pull this up real quick. All right. So I am a county pension retiree. I have 38 credits into Social Security. Can I go back to work and get my credits and receive my benefits?
Oh, absolutely. Absolutely. Even if you get, and with the Social Security program, I always get that question, I'm close. I'm retired from the state. I'm retired from the town. I'm close. Should I go back and get my additional credits to entitle me to receive something from Social Security? Then my advice has always been, yes, do it. Again, I got to double check. I haven't quite memorized these yet. In 2025, you get one credit for each $1,810 that you make in a job covered under Social Security. 1810 times 2 gets you your additional 2 credits that are needed towards the 40 that will entitle you to receive something every month from Social Security. And if you have Medicare and you have a Medicare Part B premium, and this year the base premium, $185 a month, if you've been paying that $185 Part B premium out of pocket, well, getting your additional 2 credits, putting you over the 40 now entitles you to something each month from Social Security, which, depending on how much that something is, it may be enough to cover that $185 Part B premium. So yes, if you're close, I encourage people, get those additional credits. 2025, again, you get 1 credit for each $1,810 that you make. You can earn a maximum of 4 credits during the calendar year, but it means this year you have earnings of $7,240 or more. That gets you your 4 credits for 2025 towards the 40 that you need. Now, you're sitting there with 4 credits and you're 70 years old, that's a whole different decision about whether you want to work for another 9 years to get the credits necessary. But I always say, if you're close, and can get it pretty easily, do that. Because again, it gets you something every month from Social Security. And that something, again, may be enough to cover your Part B premium and help you out that way.
Awesome. Kurt, if anybody's affected by these changes, do they need to take any action to do anything, or will the administration just handle everything themselves?
Sure. And the answer to this question, Michael, as just about every Social Security question that comes up, is it depends. Okay. What does it depend on? Well, we'll deal with folks who were impacted by the Windfall Elimination Provision. These are people who had accrued 40 Social Security credits in the past, retired from state or local or county or whatever teacher service, applied for Social Security benefits, had that benefit calculated because of the windfall provision, so they were receiving less than they would have received if they didn't have that public pension. Those folks don't need to do anything. Social Security, again, knows who they are. They're in the process of recomputing benefits for all of these folks. It applies the same way to people who, for example, had been a widow and got a Massachusetts teacher's pension and had their Social Security widow's benefit reduced by 2/3 of their pension, but they were still getting, say, a couple $100 a month as a Social Security widow's benefit. Those folks don't need to do anything. Social Security knows who they are. They're in the process now of reworking all of those cases, recalculating benefits, and again, paying retroactive payments to those folks who were on the rolls going as far back as January of 2024. But folks who were not on the benefit rolls because they'd never applied and said, "Oh yeah, 2/3 of my 2/3 of my pension is more than what I could get on my deceased husband." Yeah, those folks do need to apply for benefits because Social Security otherwise doesn't know who they are. So that's the distinction. If you're on the rolls, already collecting something, yeah, don't need to do anything. Your payments will be automatically recomputed. But if you had never applied, you do need to apply.
Hey, Kurt, this is Aaron with Archstone as well. But so I was just communicating with a client today on this who's affected by both the WEP and the GPO. They got a retro payment, but it looks like it was just the WEP because the GPO would have been a higher retro payment, and their new payment that they're getting would have been higher under what was lost from GPO. So do they need to apply if they were already in the system for WEP, but they never applied for spousal benefits?
Aaron, great question. The answer is yes. Yes.
Okay.
To get that additional money that they're entitled to receive in spousal benefits, they do need to apply for it. So if they had never applied for the spousal portion, yes, they do need to apply because Social Security doesn't know that they're a spouse of anybody.
Okay. And that's done online just like it usually would be?
So the online Social Security retirement application serves as both an application for retirement or spousal benefits. All right. So if they're looking for spousal benefits, they can go online. use that online application, and that will serve as an application for spousal benefits. Those folks, though, who are looking to collect as a widow or widower, unfortunately, there is no online application yet for Social Security survivor benefits. And those people will need to reach out, contact Social Security, make an appointment to go into a local office and sit down with somebody and take the application. But with spousal benefits or divorce spousal benefits, the online application that's there will serve as an application. But for survivor benefits, either payments as a widow or widower, you can't do that online. You need to reach out to Social Security, make an appointment, and get that application taken.
Okay. Thank you.
Yeah.
Kurt, can you?
Kurt, in that situation, then they'll tell you the higher of, correct? You'll go in because some clients might not know which is going to turn out to be higher. It might have been 5 years ago.
Sure. Absolutely.
Yeah.
Absolutely. And so now don't forget, under the new rules now about 10 years old, and this was part of the bipartisan budget bill passed back in 2015, which was the last piece of significant Social Security legislation before the Fairness Act. You go to Social Security, you are always required to take your own retirement benefit first. One of those old Social Security claiming strategies that used to be the rage said that if you're at your full retirement age, your spouse was collecting, you could opt to take just the spousal benefit and defer collecting on your own till a later point, say at age 70. That's been eliminated. So at whatever point you go in, you have to take your own retirement benefit first. Assuming you then list on your application that you're married, provide information about who your spouse is, that will trigger Social Security to investigate whether you might be due some additional money in Social Security spousal benefits. And they will do that by comparing your full retirement age amount with 50% of your spouse's full retirement age amount. And if your own exceeds 50% of your spouse's, as I said earlier, you collect solely based on your own work record. But if your own is less than 50%, you collect on your own and then get some additional money on top of that, bringing you up to that 50% of your spouse's full retirement age amount. But yeah, always have to take your own, but listing that you're married or divorced with the right amount of years of marriage, Social Security will investigate whether you might be due some additional money, either as a spouse or ex-spouse.
Cool. And I'll just remind everybody, if you have any questions, please feel free to use the Q&A chat box at the bottom of the Zoom page. You can type in any question you'd like. Couple more for you, Kurt.
Sure.
Can you provide your opinion on the current state of affairs, such as the suspension of Social Security phone service, the closing of offices, and the reduction of their staff?
Yes, it breaks my heart. As a 34-year employee of the Social Security Administration, worked with good people throughout the entire time, knew that the folks at Social Security were there because they believed in the mission of the agency. They were trying to help people and do good. It kills me, tears my heart apart to watch the dismantling of a proud agency. And I have no particular insight. I haven't worked there for 15 years. No particular insight what's going on other than reading what's going on in the paper. But it just tears my heart apart. And I feel so sorry for those people who are stuck in the mess they're in because again, yeah, maybe a couple of outliers, but by and large, the people there have always had their hearts in the right places, looking to help people, do good for people, and to have that rug pulled out from under them. It's just a terrible situation. Terrible situation.
Gotcha. Monthly payments for Social Security, are they reduced by Medicare and taxes?
So, good question. So you get a monthly payment. If you have Medicare Part B, which is the doctors and hospitals, non-inpatient stuff, regular medical coverage. If you have Part B of Medicare and are getting a Social Security payment, then your Social Security payment has the Part B premium deducted from it. It's done automatically. You don't have a choice in the matter. You have a Social Security benefit of some type. You have Part B of Medicare, your Part B premium automatically deducted. But with federal income tax, Social Security will not automatically withhold federal income tax from somebody's Social Security benefit. However, if somebody would like to have taxes withheld, they can do so by completing a form W4V, as in Victor, W4V. And upon someone's completion of that form, they're given 4 options. They can ask to have 7, 10, 15, or 22% of their benefit withheld in advance, sent to the IRS in advance, which may avoid the need for filing quarterly estimates. But tax withholding entirely voluntary. Part B Medicare, not voluntary, done automatically. Now, what about state taxes? Well, the good news is the vast majority of states, 41 out of the 50, do not tax Social Security benefit payments at the state level, including here in the Commonwealth of Massachusetts. But that leaves 9 states that do. Here in New England, Rhode Island, Connecticut, and Vermont do tax Social Security benefits at the state level in some form or fashion. So if someone is in one of these 9 states, they may ask to have state income tax withheld from the Social Security benefit, but Social Security can't do that. The only thing that can be held voluntarily from a Social Security payment is federal tax payments, and it's based on an estimate or 7, 10, 15, or 22%. And the good news is you can change that each and every month if you want to. Ask to have taxes withheld, suspend the withholding, change the rate, all of that. But it's federal tax rules, and it's voluntary, not mandatory, but the Part B Medicare premium withholding is mandatory.
Gotcha. All right. This one's a little specific, but I know you'll try to answer this one the best way that you can. I taught in public school for 23 and a half years. I'm receiving 40% of my average salary through Social Security. My taxed Social Security.
Social Security or an MTRS pension?
It does not specify.
Okay. That's probably the amount of their pension. Go ahead, keep going.
Yep,
Sorry.
yep. My tax Social Security earnings in my working career total 47,500 paid in 12 different years. What annual Social Security benefit can I expect to receive at age 65?
Beats me. So no, that part of it is, so it's going to be based on an average of someone's highest 35 years of work under the system. And it's your high 35 right up until the time someone retires. So if this person is, 40, and they continue to pay into the system, so they're paying in more. I mean, all of those things that come in. So that's why you want to make sure, if you haven't done so yet, make sure you set up a My Social Security account for yourself. www.socialsecurity.gov/my-account. Take about 15 or 20 minutes to put that account in place. And having that account in place then will enable you at any point you need one to receive a Social Security statement and receive a benefit estimate based on your actual earnings. And so my recommendation for this person, set up that My Social Security account, download a Social Security statement, and you'll see, based on the earnings that you have to date and assumptions going forward, how much you could expect to receive at different ages going forward.
Kurt, can you also use that same site to find out how many credits you have?
Absolutely. Yep. That's one of the great things. Set that account up, and it will tell you, to receive a Social Security retirement benefit, you require 40 credits. Based on our records, you have 32 or you have 36. Or if you've got 40, it'll say you have 40. And that's the important thing. You need 10 years of work, 40 credits to get your foot in the door. All right. And it's really kind of this cliff. If you don't have 40, you can never receive anything based on your own work record. Now, you may be able to collect as a spouse, divorced spouse, or widower, but absent 40, you can't collect based on anything based on your own work record. But you cross that 40 threshold, you're always going to get something based on your own work record. Then it's a question, might be eligible for some additional money based on the work and earnings of your spouse, deceased spouse or ex-spouse. But yeah, that Social Security statement tells you that. And now, 2025, you get one additional credit for each $1,810 that you make in a job, again, covered under Social Security, so that you have earnings of $7,240 or more. The key thing is, it doesn't matter when you make it. You go to work one day and you make $8,000, you've gotten your 4 credits through that one day of work. And again, always encourage people, if you're close, get those additional credits, entitle yourself to something each month from Social Security when the time comes. May not be a lot, but it may be enough simply to just cover your Medicare Part B premium.
Wonderful.
Sorry, go ahead.
Go ahead.
Oh, okay. I was just going to ask a couple of things. So
Yeah.
you mentioned earlier that Social Security is, won't be able to pay out its full benefits in 2035 if nothing changes. And then you mentioned that the Social Security Fairness Act makes this potentially a little bit worse. And then you said you don't really like what's going on in the administration and as far as how the system's working. So can you talk to a little bit about what you would, and you've said you're not a good predictor, but what would you predict is going to be happening, going forward? Should we be working with clients to plan on worst case scenarios of Social Security changing? Should we be addressing this in more detail, or is it kind of they're going to figure it out and everyone's going to get their whole benefit, their whole life?
Well, I think everybody's going to get their whole benefit, but it's just how much is that whole benefit going to be? So I always say there's a lot of stuff out there about the future of the Social Security program. Again, I worked for the agency for 34 years. My default position in judging the future of the program is to look at something called the annual trustees report produced by the Social Security Administration. The trustees of Social Security are Secretary of Health and Human Services, Secretary of the Treasury, Secretary of Labor, the Commissioner of Social Security, and then 2 members of the public. But each year in the spring, the Social Security actuaries sit there, bubble, toil and trouble, hair of frog, eye of newt, massage all the future predictions about the economy, demographic changes, and they make a prediction, not just where they make statement about where the system is at that moment, but also attempt to project 75 years into the future. And it was the most recent trustees report, which came out in May of 2024, that said, again, it's currently constituted, the projection is Social Security would have enough money on hand through the end of the year 2034 to cover 100% of the benefits that have been promised. But beginning in 2035, again, assuming no changes to the program were made, there'd only be enough money coming in to cover about 83% of the benefits that have been promised. Now, to me anyway, that's an important point for people to be aware of. Younger folks, Aaron, like you and Michael, I hear from them all the time, there's not going to be anything there for me down the road. Keep in mind, Social Security's primary source of income is payroll tax dollars paid by employers, employees, and people who are self-employed. So absent a complete and total collapse of the United States economy so that nobody anywhere is working, Mad Max beyond Thunderdome type of situation, Social Security is always going to have a revenue stream of some sort. The question is, looking down the road, is that revenue stream thought to be enough to cover 100% of the benefits that have been promised? And the most recent trustees report from a year ago said it is till 2034, but beginning in 2035, only enough to cover 83%. Now, the thing is, that latest trustees report didn't incorporate the additional money that the system needs to pay out under the terms of the Social Security Fairness Act of 2023. And Congressional Budget Office estimates are that it would cost the system about $1.9 billion over the next 10 years, certainly exacerbating that financial shortfall. Now, in some ways, Congress needs to deal with the issue. And it is incumbent on Congress, because the Social Security rules passed by Congress, that they need to deal with the issue sooner rather than later so younger folks can plan accordingly. But in terms of, global view, Social Security is really money coming in, it's money going out. Payroll tax dollars collected, benefit paid out. So the system, the big problem is not altogether different from somebody's situation at home. If at the end of the month you don't have enough money to pay all your bills, you got to bring more money in or pay less money out. And so with Social Security, you can close that gap on the income side by bringing more money in through, well, payroll tax rate. Right now, you pay a 6.2% payroll tax up to a maximum level. Well, that payroll tax rate of 6.2% has been unchanged since 1991. Well, so you increase the rate a little bit. That'll bring some more money in. You have that taxable maximum level. Well, maybe you bump that up a little bit. You slow down benefit outflow is another way. Well, you could do that perhaps by raising full retirement age again, or raising the early retirement age, or maybe increasing the number of years that are used to calculate somebody's benefit. There's all kinds of options and choices that are out there that people have looked at and come up with the financial impact of, but it's incumbent on Congress to finally deal with the issue. But the problem is there's no magic bullet. Whatever Congress comes up with is going to cause pain to somebody. And so they're very reluctant to deal with the issue. And they should do it sooner rather than later. But as we see, Congress tends to lurch from crisis to crisis. So again, so that's a long-winded answer. In terms of helping your clients plan, I tend to look at the trustees report that it comes out and say, okay, as currently constituted, 83% absent any type of change. So that seems to me to be a reasonable planning amount going forward. Unlikely you're going to continue to get 100%, unlikely you're going to get 0, but look at that and use that as a planning figure to use in determining what might be happening to the Social Security program down the road. But it is going to be incumbent on Congress to deal with it. In some ways, again, the Fairness Act exacerbated the funding situation, and maybe it'll spur Congress into acting sooner rather than later. I don't hold out much hope to that. But I think the big issue is, absent a complete and total collapse of the United States economy, there'll always be a revenue stream of some sort. It's never going to be nothing. And, and what you're seeing now these days with the Doge folks, they're not dealing with benefit payment amounts. They can't do that. That's totally on Congress. What they're dealing with are service delivery issues. And that's what, it's not good. People just need to have access to the system. But they're not, any of those cuts, they're not talking about funding the system down the road. They're not exacerbating that issue. They're making service delivery cuts, closing offices and things like that don't have any impact at all on benefit payment amounts and the future benefit payments. So,
Okay, thank you.
Anyone? Bueller, anyone?
Chris, anything on your end before we finish up?
Yeah, this is sort of specific, but I think it covers a lot of bases. Situation, wife was a school teacher, age 70, didn't pay into the system. Husband, younger, she's 70, he's 60, he's paid in. He's eligible. She's eligible, but he's too young to collect, and she's age 70. So, am I understanding this correctly, that he actually has to claim for her to get anything? So he's going to maybe go at 62. Is there an idea of going earlier than you planned otherwise to get your spouse a benefit?
And that's why you guys are advisors. That's why you help them out. But Chris, that base point you make, she can't collect anything on his work record until he starts to collect. And so at that point, sure, as his spouse, she'd be eligible for a payment equal to 50% of his full retirement age amount, moving from her own, whatever it is, up to that 50% of his. But until he actually starts to collect, she can't be paid on anything other than her own work record. And so, so you weigh the trade-off. Okay, so she comes in, starts to get 50%. Does that, is it worth his while to take the haircut by taking a reduced amount to trigger her eligibility for something? But keep in mind this, we kind of haven't talked about this. Under the Social Security rules, anyone who has not yet reached his or her full retirement age, whatever it might happen to be, in this guy's case, it's going to be 67. If they're still working, there's an annual earnings limitation that comes into play that impacts whether or not A, he can collect, and then B, whether or not she could collect anything. Now, this year, you're allowed to make up to $23,400 without any loss of benefits. But you make above that, Social Security starts to hold back $1 in benefits for every $2 that you're over. So this guy, if he's making a lot of money at age 62, even if he wants to collect, if he's still making a lot of money, Social Security might be required to withhold more than they could pay him in the first place, and she might not be able to collect. But once he reaches his full retirement age, that earnings limitation goes away. He could collect regardless of what he was making while working, and that would trigger a spousal benefit payment to her. So yeah, prior to full retirement age, you're taking a lower amount, but you're also going to be subject to that earnings limitation, which, if you want to continue to work, would also impact whether you, and in this case, the spouse, could collect anything as well.
Yeah. In this case, he is retired,
Oh, okay.
but was going to wait till 66, 67, but this changes the equation on that. So it's
Absolutely. Absolutely. Now she
calculator
can
out there
get
that
something, but not
Yeah.
till he turns 62, earliest age, once he starts to collect. So basically, he's going to get 30% less than he'd receive if he waited till his full retirement age. But that triggers some additional money for her, and you can run the numbers and see whether it makes sense or not.
Thank you.
Wonderful. I know we've ran a couple minutes over, so Kurt, greatly appreciate you being very generous with your time, and
Sure.
thank you for running through this great presentation this evening. It's been great to hear what you have to say. And
So an offer to folks on the webinar, we talked about a lot of stuff. Your head might be spinning. If you have questions that occur to you down the road, get them into your advisor. They'll get them to me. I'm very happy to answer questions that may come in a little bit later.
Yep, it's been super beneficial for us.
And I think we're recording the session as well, right?
We are.
And so I've been led to believe that this will be on HBO once season 3 of The White Lotus is over. Then this webinar will be airing Sunday nights on HBO in the slot now occupied by The White Lotus season 3. So just something for people to look forward to.
You're about to be the star of the whole thing.
Maybe not.
Oh, that's funny. That's a great way to end. We'll end it on a high note. Thank you so much for being with us this evening, Kurt, and thank you for joining us, everybody. It's a pleasure working with you, and we hope you gain some insight from the webinar this evening. So thank you very much. Have a great
Take care,
night.
everybody. Stay safe. Enjoy the spring.
Bye-bye.
Bye-bye.